As of 10:16 a.m. Eastern Time on October 27, 2025, General Electric, or GE, is trading at $309.84. That's a very strong move for the day, up $5.97, or just about 1.96%. The stock is pushing hard against its 52-week high of $316.53, showing significant momentum just as the trading week kicks off. This move is a direct follow-through from the company's absolute blockbuster earnings report last week, but the immediate insight here isn't just that the numbers were good. The real story is that Wall Street analysts are now scrambling to update their models because the stock has officially outrun most of their price targets, and the market is signaling that the consensus view of this company is fundamentally wrong. The general expectation for General Electric, especially after the final spin-off of the energy business, GE Vernova, earlier this year, was that it was settling into its new identity. The belief was that GE was now a mature, cyclical, and somewhat boring aerospace company. It would be a solid, high-quality industrial, but its days of exciting growth were over, left behind with the high-flying healthcare and energy sectors. Investors expected a company that ebbs and flows with airline orders and defense budgets, a reliable GDP-plus grower, but nothing to get excited about. The frustration many investors have been voicing, particularly on social media, is that the stock's valuation, which is running at a P/E ratio well over 40, seems completely disconnected from this boring industrial expectation. It looks expensive, and for months, the narrative has been that it's overvalued. The reality, however, as blasted out by last week's Q3 earnings report, is that this company is not a boring industrial. It's behaving like a high-growth, high-margin services and tech company. The numbers were not just a beat, they were a complete dismantling of bearish expectations. The company reported adjusted earnings of $1.66 per share, crushing the consensus estimate of $1.46. That's a 13.7% surprise. Revenue was even more impressive. Adjusted revenue hit $11.3 billion, which was not just $1 billion over estimates, but an 850 basis point beat. That's 26% growth year over year. Think about that. A 133-year-old company, stripped down to its mature core, growing revenue at 26%. On top of that, free cash flow came in at $2.4 billion, up 30%, and management, for the second time this year, raised full-year guidance. They are now projecting full-year adjusted earnings between $6 and $6.20 per share, with high teens revenue growth. The expectation was for a company slowing down. The reality is that it's accelerating. Let's look at what's driving this because it's critical. The strength is coming from both of its core segments. The commercial engines and services division saw revenue jump 27%. The key here isn't just selling new engines, it's the services. That's the cash cow razor blade model. Services revenue was up 28%. But to get that future services revenue, you need to sell the razors first, and they are. Deliveries of the LEAP engine, the new workhorse for narrow-body jets, hit a record, surging 40% year over year. This is the seed corn for decades of high-margin repair and parts revenue. Then you have the Defense and Propulsion Technologies division. This division saw revenue climb 26%, which is impressive, but the underlying number is staggering. Defense deliveries were up 83% year over year. This isn't just a commercial travel rebound story. It's a defense spending story running at full throttle. This is why the stock is rocketing. The market is realizing that the new GE isn't a cyclical industrial. It's a duopoly, along with its partner Safran in the CFM joint venture, in a market with massive barriers to entry, with a locked-in, high-margin, recurring revenue services business that is just now hitting its stride. Now let's talk about the sentiment, because this is where the story gets tense. If you go on X or look at Reddit forums, you see a deep divide. You have one camp that is completely bewildered, looking at the 42 P/E ratio and the 7.9 PS ratio, both near 10-year highs, and they are correctly pointing out that this is wildly expensive for an engine maker. They see the insiders, who have logged 9 open market sales in the last 6 months and 0 buys, and they take that as a sign that the people running the show are cashing out at the top. This creates a lot of frustration and disbelief. Retail traders are feeling overconfident if they're long and completely run over if they're short. The short interest itself is very low at only 1.22% of the float. This is not a short squeeze narrative. Nobody's betting heavily against this. However, the frustration for retail is not about short sellers. It's about the trading mechanics. We've seen a few days recently where the off-exchange short volume often attributed to dark pool activity, has spiked to 48%, 50%, or even 70% of the total volume. This feeds the retail narrative that while the stock is rising, the real price discovery is being hidden and that big institutions are playing by different rules. But the real battle here isn't retail versus hedge funds. It's hedge fund versus hedge fund. The institutional filings from Q2, which are the most recent complete data, show a massive rotation. On one side, you had major funds like GQG Partners dumping their entire $2 billion position. Dodge & Cox also sold off a huge $1.2 billion block. This is the old guard saying, this is the top, the valuation is insane, we're out. But on the other side of that trade, you had T. Rowe Price come in and add $1.4 billion worth of stock, and Wellington Management added $724 million. This is a battle of theses. The sellers see a cyclical, overvalued industrial. The buyers see a high-growth, services-driven tech company in disguise. After last week's earnings, the buyers are clearly winning the argument, and the sellers are likely feeling a deep sense of regret. The momentum is undeniable, and the volume we're seeing today, while still early, suggests institutions are still piling in, not selling into the strength. So let's quickly establish what this company actually is for anyone who hasn't followed the story since the spin-offs. The original General Electric, founded in 1892, is gone. In January 2023, it spun off GE Healthcare. In April 2024, it spun off GE Vernova, its energy and power division. What remains is the legal successor, GE Aerospace. This is the crown jewel. This company designs, builds, and most importantly, services a global fleet of nearly 70,000 commercial and military aircraft engines. Its joint venture with Safran CFM International is the world's leading supplier of engines for single-aisle jets, holding about 39% of the market. GE itself holds another 14%. They are the market. The business model is simple. Sell the engine, often at a low margin, and then lock in a 20 to 30-year service agreement for all the maintenance, repairs, and spare parts. That services revenue is extremely profitable and predictable. Last week's 40% surge in LEAP engine deliveries isn't just 2025 revenue, it's a guaranteed revenue stream for 2035, 2045. This is the moat. They're benefiting from the massive global travel rebound and increased defense budgets, and because they are a focused company, all that cash flow can now go to share buybacks and R&D, not to propping up a struggling power division. This brings us to the future outlook, which is now where the tension lies. The stock is trading at $309. The analyst consensus is a buy, but here's the problem. The median analyst price target is $297.50. Public.com's consensus target is even lower at $275. The stock is trading above most of Wall Street's targets. This is a classic case of the market being ahead of the analysts. The analysts who set those targets were modeling the boring industrial expectation. The Q3 earnings report broke that model. Now we are seeing the scramble. The newest targets issued just after the earnings are much higher. UBS, for example, has a $321 target. Citigroup is at $309. The high-end target on the street is $375. The market is now in price discovery mode, trying to figure out what the new correct valuation is. The bullish scenario is that the global travel boom continues, defense spending remains robust, and GE continues to expand its services margins. In this case, the company grows into its high PE ratio, and the $375 target comes into play. The bearish scenario is that we hit a global recession. Air travel, which is highly sensitive to economic pain, could fall off. That, combined with high interest rates and persistent inflation, could crush margins and halt new orders. In that case, this stock, with its high-flying valuation, will be the first one punished. They have an installed base of nearly 70,000 engines. That's the real moat. Let me know in the comments, do you believe this services-driven model justifies the high PE ratio, or is GE flying too close to the sun? So to wrap it all up, the expectation that General Electric was a finished story, a dismantled relic of the 20th century, has been proven definitively wrong. The reality is that the spin-offs, far from being an end, were a beginning. They have created a focused, lean, and incredibly powerful aerospace and defense leader. The company is firing on all cylinders, from commercial to defense, and is generating massive amounts of cash flow. The market is now grappling with how to value this new entity. The old industrial multiples no longer apply, but the high-tech multiples feel dangerous and unfamiliar for a company with this name. The The Q3 earnings report was a validation for the bulls and a wake-up call for the bears. The stock is now trading at a high altitude, reflecting this new reality, but it also means there is very little margin for error. The company has to keep delivering perfection just as it did last week.